Most people think investing in art, rare watches, or fine wine is only for millionaires. That's wrong. Today, everyday investors can own a fraction of these assets and potentially earn double-digit annual returns without spending hundreds of thousands of euros. In this video, I'll show you how fractional investing in collectibles really works. Traditionally, investing in collectibles was only possible if you had a lot of capital, deep market knowledge, and access to dealers, auctions, storage, and insurance. Buying a Picasso, a rare Rolex, or a collection of investment-grade wine wasn't just expensive, it was complicated. Fractional investing changes that. Specialized platforms buy a high-value physical asset, for example, a painting, a rare watch, or a case of fine wine, and then split ownership into thousands of small fractions. You don't buy the entire asset, you buy a fraction of it. That fraction represents your economic ownership in the asset and your right to benefit if it increases in value and is later sold. In simple terms, you and thousands of other investors own the asset together. The asset itself is usually stored securely in professional vaults, bonded warehouses, or specialized storage facilities, and insured against theft or damage. You never have to worry about storage, maintenance, or logistics. Now let's talk about returns. Unlike interest-based investments, collectibles do not pay regular income. Your return comes from price appreciation. If the asset increases in value and is later sold, investors receive their share of the profit. Depending on the asset category, platforms often target annualized returns in the range of 10% to 30% or more, but this is never guaranteed. Some assets are held for just a few months. Others are held for several years. There is no fixed maturity like in bonds or loans. The exit usually happens when the platform decides market conditions are favorable and organizes a sale. In some cases, platforms also offer a secondary market, where you can sell your fraction to another investor before the final sale. This can improve liquidity, but it depends on demand. Now let's be very clear about risk. Fractional investing in collectibles is not risk-free. The biggest risk is simple: the asset might not increase in value. It could stagnate or even decline. Collectible markets are driven by trends, taste, scarcity, and global demand, not by cash flows. Liquidity is another key risk. Unlike stocks, you cannot always sell instantly. Even with secondary markets, buyers must exist. You also need to make sure that your assets are properly stored and insured. There is also platform risk. If the platform fails operationally, investors rely on the legal structure that separates assets from the company. This structure is critical, and investors should always understand it before investing. And finally, collectibles are not regulated like traditional financial instruments. There is usually no investor compensation scheme. That's why diversification is essential. These investments should complement a portfolio, not replace core assets like ETFs or bonds. Now, who is this type of investment for? Fractional collectibles are designed for retail investors who want exposure to alternative assets, who can invest smaller amounts, and who are comfortable with long-term investing. Minimum investments often start from €50 to €250, depending on the platform and the asset. Most platforms are open to European investors and require standard identity verification. Let's briefly look at a few examples. Platforms like Timeless Investments focus on luxury collectibles such as watches, classic cars, sneakers, art, and rare spirits. Investors can buy small fractions, track asset value over time, and in some cases trade their shares on a secondary market before the final sale. Convi positions itself slightly more toward premium and curated assets, with average returns of 35%. Investors typically commit higher amounts and accept longer holding periods, targeting appreciation in high-end collectibles and niche alternative assets. For investors interested specifically in art, Mattis focuses on curated contemporary artworks. Instead of trading frequently, the model is built around medium-term holding periods, with returns depending entirely on the resale of the artwork in the global art market. WineFi concentrates exclusively on investment-grade wine, allowing investors to gain exposure to carefully selected wine portfolios that benefit from long-term scarcity and global demand. Despite the differences, the core idea behind all these platforms is the same. You are investing in real, tangible assets. You own a fraction of something physical, and your success depends on the long-term value of that asset. To sum it up, fractional investing in collectibles opens the door to markets that were once inaccessible to most investors. It offers diversification, inflation hedging potential, and exposure to real assets. But it also requires patience, realistic expectations, and a clear understanding of risk. This is not a replacement for traditional investing. It's an addition for investors who want something different. On crowdinform.com, you can explore and compare fractional investment platforms, understand their models, see minimum investments, asset types, and risks, all in one place. If you want to learn more about alternative investing, make sure to subscribe and follow Crowdinform.